Is the economy headed toward what I'm calling the Great Collapse? Is the stock market headed for an unprecedented correction? Why should you care? Well, take a look at this. During the COVID crash, which admittedly was a V-shaped recovery, which is unusual, but during the COVID crash, if you had bought when the panic was the highest, the VIX, or the fear gauge, spiked to 80 intraday. Here you can see on a S&P index fund, triple leveraged, you would have made 631% in less than 2 years. The return is even more dramatic on the TQQQ, which is again an index fund, triple leveraged NASDAQ. In less than 2 years over the same time period, you could have made 832%. Those, my friends, are life-changing gains, and that comes from nothing more than an index fund. Do I have your attention now? So in the triple leveraged S&P fund, if you had invested $10,000 and netted the 631% gain, that would be $73,000 in under 2 years. Pretty easy for a few clicks of a mouse in your Robinhood account, and keep in mind you weren't speculating in small cap stocks that might blow up and go to zero. This was an index fund. In the TQQQ, every $10,000 would have become $93,000. Now, why am I talking about this? After all, Biden has come out and told us the economy is strong as hell while eating ice cream in Portland. Well, thanks, Joe Biden. He even managed to make a teenage girl extremely uncomfortable and continues to show the world why he's so gross. But this video isn't about Joe Biden's predilection towards perversion. This is about his economic illiteracy. See, if you haven't been paying attention, the stock market, measured by the S&P 500, is down about 25%. And that's fairly significant, and has many people asking, is the bottom in yet? Well, for some perspective, the average recession drags the market down by 35%. That would be average. In 2008, the market went down nearly 50%. So looking at some numbers, on the S&P 500, going down to 3150 would represent a normal, quote-unquote, recession. A 50% decline would be all the way down to 2400. And so you could expect an above-average recession to be somewhere between 2400 and 2800, with lows I've seen as low as 1800, which would truly be catastrophic. On the NASDAQ, you're looking at a downturn somewhere between 6,000 and 7,500, with a catastrophic low of 4,000. So we have some basic numbers, some basic benchmarks to work with there. Now, this wasn't widely reported, but the UK pension system was a mere 3 hours from complete collapse. This is the sort of systemic collapse we tend to see that kicks off a real market financial crisis. As John Malden, the economist, says, it creates these fingers of instability that build up. We don't really know what's going to break, but as the Federal Reserve continues to raise interest rates, that puts pressure across the financial system, and sooner or later you just get stuff breaking that nobody thought would break. Everyone thought it was safe, and we're already coming close to seeing those breakdowns now. The systemic collapse results in these money managers getting just tons of redemptions. Redemptions lead to more redemptions, and the shutting down of funds, that leads to mass liquidations. And this is where you get those fireside bottoms that set up these enormous returns. Now, why do I look for these bottoms? Because I'm poor, and it's really hard to make money in markets when you don't have a ton of money to invest. 4% interest is great if you have $40 million. If you have $4,000, it's practically nothing. Just get a side job. Now I want to look at how your 401k screws you and why you need to time markets. So we're just going to assume averages. This is just a back-of-the-napkin thought experiment. You're going to start with $10,000 and your wealth is going to compound at 8%, just like they say, markets on average compound at 8%. Well, markets on average also correct 35% during recessions, Those recessions hit, on average every 7 years. So let's look at how this goes. Your first year, you start with $10,000, you earn 8%, you now have $10,800. The next year, you have $10,800. It goes up by 8%, you have $11,600. And you can see this progression as we go down, and there after 7 years, your $10,000 has grown into $17,000. Pretty good, right? 7 years, you've been working, that's almost a decade, and then, an average recession hits, and you're back down to $11,100. You've slid down all the way back, not quite where you started, but almost to where you started. And now you begin again. Chutes and ladders, financial style. This is how the system keeps you in prison. This system, passive investing, is literally designed to keep you a slave for life. You will slowly work and slowly save over your entire life, hopefully getting more favorable market environments than not, hopefully avoiding, say, 50% drawdowns, which would make this even uglier. And then you'll be able to retire and live off what you've saved for your final 10, 15 years of life. It's an ugly thing. Now, if you time that market, say you got up to that 17,000, saw a crisis selling, sold it, and then got in for a 300-400% gain over the next 5, 6, 7 years, like we saw with the crash in 2008, well, then your 20,000 goes up 400%, which would put you at $100,000. Now you're making money. But timing the market is impossible, they say. Well, here's the thing, guys. You don't have any other choice. If you're a working class stiff, you have no other choice. So how much time, how much energy have you put into getting your college degree or your GED or just going to your job? Thousands and thousands of hours, right? How much time have you put and dedicated towards studying finance and markets? Most of you probably very little. You are going to reap what you sow if you don't try. And here's the thing, you actually don't have a choice to not invest in your 401k either, because that company 50% match that most companies give is a return that you're never going to beat anywhere else. Nowhere do you invest $100 and immediately get $50 in return. You have to max that out. Now, I've provided resources on this channel before, and one of them I recommend reading Your Daily Wealth. So we're going to go over a couple of those that can help us at least loosely time the market, because nobody's going to nail it, right? But get out during the big declines and get in when the getting is good. You have to educate yourself. I'm sorry, there's no other way. So looking at Friday's episode here, Dan Ferris writes, stocks are still in a mega bubble territory. Well, what does that mean? This is a great article. It only takes 5 minutes to read. I highly recommend you read it. But this one simple graph sums it up in a nutshell. So the S&P peaked on January 3rd, 2022, and has fallen 25%. At the peak, it traded at a ratio called the price-to-sales ratio of 3.2, which is the highest ever. After this 25% decline, it is trading at 2.2 times sales. Wow, that's a big drop, right? Well, actually, at the peak of the technology bubble in the year 2000, the biggest stock mania ever, at least at its time, the market traded at 2.2 times sales back then. So actually, the current crash has only got us back down to the peak of the mania in the year 2000, which means we can have a long, long way down still to go. Furthermore, he looks at the length of the average bear market in days. We are currently 300 days into this bear market, and the average bear market tends to last somewhere between 500 and 1,000 days. As an aside, Japan has been in a bear market for 23 years. That's what happens when you tell yourself deficits don't matter, so take that, Bernie Sanders economics. In Saturday's article, Dan Ferris continued that it's far too early to be bullish. He writes, in the first third or half of a bear market, everybody wants to be a hero. Every market observer wants to be the person who calls the bottom and looks like a genius. But just as bull markets don't end until the last bear is gored, bear markets don't end until all the bulls have been grounded to burger meat and all the hero wannabes are gone. We're simply not there yet. He talks about how everyone's counting on the Federal Reserve to pivot and begin going back to easing interest rates and pumping money into the economy again. But again, Jerome Powell has been very hawkish. If you're betting on a Fed pivot, you're taking an incredible risk. So what would I look for? Well, I'm going to be watching the volumes on the sell-offs because during big market crashes, the volumes are easily triple average. We're not seeing those level of volumes. The other thing I'll look at is we're going to see the VIX spike. The VIX is in the 30s right now, low 30s. That is quite high. But that's nowhere near the crash highs, at least through the market crashes I've invested through. Like I said, during COVID, it hit 80 intraday. So it's just look for those. You're going to see the VIX, and it's going to spike incredibly high, and you're going to see mass liquidations and sell-offs. But then what happens is you usually don't get a V-shaped bottom. You usually get, I don't know what it could be, 6 months or so of just the market churning along the bottom. You will have time to get in. At least that seems to be typical. Sentiment will be so bad, the financial news and the media will actually move on, and the stock market will largely be forgotten by the average investor. They'll be so disgusted with the performance they've had over the past 2 or 3 years, they don't even want to talk about markets. They will be left for dead. So that's what I've got for you right now as for market analysis. Because if my suspicions are correct, soon the market is going to be all the news, all the time.